2009. And we're an advisory-focused independent investment banking firm with professionals in Charlotte, Washington, Chicago, and New York. And each month, we price or mark to market over $50 billion of financial assets. So that will be things like whole loans, illiquid securities, private companies, financial derivatives, et cetera. And over the last 25 years, I've had the opportunity to invest in or advise on nearly $1 billion worth of private equity, private debt, real estate transactions, et cetera. And I've also had the opportunity to serve as a senior advisor or a board member of a variety of companies, organizations, and institutions. Now, I'm very passionate about contributing in areas where public policy and the capital markets intersect. And so I've been fortunate to also have had the opportunity to participate or contribute to several national studies and reports, and have been an invited guest at the White House during the last 3 presidential administrations. As a company, Trade Street has been privileged to assist the university in managing its investments in its portfolio of what we call technology spinoff companies. And at Trade Street, we refer to these companies as the discovery portfolio companies. And we've been an advisor to the University of Maryland on that since 2018. Now, the title of this webinar or workshop is Managing and Increasing Your Company's Intrinsic Valuation. However, the purpose of the workshop is twofold. First, it's about managing and building the financial value of your company, but it's also about dynamic storytelling. So you may have a great product or service that you're passionate about, but in addition to that passion, when negotiating with or pitching prospective investors, capital providers, or potential acquirers, you have to weave in a compelling story about the numbers, a story that speaks to the financial value of your company. Now, why is this important? This is important because, one, you need to help them connect the dots as it relates to why should they invest in your company, and 2, why your company should be valued higher than alternative investment options or companies that they may be looking at. Now, for clarity, our focus today is on high growth emerging companies in the broad sectors in which the UN Ventures Discovery Portfolio companies participate, and that would be climate adaptation and sustainability, computing, data and discovery, human health, national and global security. Now, how do we define intrinsic value? So intrinsic value is defined as the value of a business's ongoing operations based on its expected level and certainty of future cash flows. So fundamentally, intrinsic value is forward-looking. Now, past data is very helpful, but it's helpful in that it provides a good starting point. And depending on the track record, it could also give us an idea of how much confidence we can have in what we expect in the future. But intrinsic value in itself is actually a forward-looking concept. And as we're going to discuss during this presentation, there are 4 key underlying factors driving intrinsic value. And those factors underlie every commonly used valuation approach. So for that purpose, for that reason, we're not going to spend a lot of time on the valuation approaches. We're going to talk about them, but we're really going to spend more time on the drivers of intrinsic value, because increasing the intrinsic value of your company will likely result in higher valuations, irrespective of the valuation approach or of a particular deal structure. So one of the things that it's important to point out when it comes to standard valuation approaches is that the valuation approach that's applied by a valuator, investor, or acquirer is very situation specific. The approach that they choose to apply depends on the scenario. It depends on the company's stage of development and numerous other factors. So there's just a dizzying array of valuation approaches that are often used and applied, but they all fall into four broad categories. The first category is the asset or cost approach. And this is where the cost to recreate or replace the asset being valued is the focus. But the problem with this approach is that this approach really focuses on liquidation scenarios. It's not really a suitable or helpful approach for scenarios where the company intends to continue to grow and to be an ongoing viable concern. So this is not one that's highly relevant for most established companies. And then we have the market or sales approach. And that's where the valuator uses actual sales prices of either the company's own securities or those of comparable companies to try to assign a value to this company. And this is where you get the concept of multiples, revenue multiples, EBITDA multiples. When you say that something sold for 5x revenue, they're really talking about the market or sales approach. Then the income approach. The income approach is the most comprehensive of all of the approaches, and it involves forecasting the company's expected cash flows over its life and then converting those cash flows to present value through a process called discounting. And we'll talk a little bit about discounting as we get further into the presentation for those of you who may not be as familiar with that term or concept. Then we have the alternative approaches. And these alternative approaches are what I refer to as actuarial methods. And that's where the valuator starts with an average, deal size or valuation that you might find for a typical comparable company. And then they will make up or down price adjustments based on the risk associated with your company. And these are most appropriate for valuing pre-revenue and very early stage companies. But what we're finding as we look out in the marketplace and look at the deals that are getting done at the angel and the pre-seed level is that these approaches are becoming much more common in the marketplace. So it's helpful to actually have some familiarity if you're at the angel or pre-seed stage in the very early stages of your company. And some of those approaches are outlined here. They're called the scorecard valuation method, the risk factor summation method, and the Berkus approach. But there are a lot more of them. There's a wide variety of approaches. But as we look at valuation approaches by company stage, what we can see is that some version of all four approaches are applicable and suitable for angel and pre-seed. So when we say angel, we're talking about, companies that are small enough to be, family, friends, and maybe an angel investor, an individual who may have some passion about your business or your space. And pre-seed would be the stage right after the angel stage. But as we move into seed, we can see that alternative methods begin to drop off. And that's because today, just seed stages are occurring later and later in the life cycle of a company. So, in this description, it will say that rounds range between $10,000 and $2 million. But today, we're seeing rounds that are closer to the 2 million end of the range. And at that point, you're looking at using, methods such as the market approach and the income approach, and the alternative approaches begin to drop off. Now, as we get into Series A through C, and sometimes you'll see Series Ds and Es, these are the venture capital rounds, the VC rounds. And so as we start getting into the institutional investors, the venture capital funds, the private equity funds, et cetera, when we look at Series A through private equity, which is just a type of funding approach that's used for more established companies, we see an almost exclusive focus on the market approach and the income approach. And then as we get into the corporate rounds, we see a focus on the income approach. And that's because the corporate buyers tend to have strategic reasons for wanting to acquire or invest in a company. So they're going to consider factors that can only really be well captured in the income approach. And those factors might be things like synergies, their cost of capital, et cetera. So we'll see, again, at that stage, you're really looking at the income approach. Now, I didn't want to spend a lot of time on the valuation approaches, but I'm certainly available if you want to have a one-on-one discussion or follow up and talk more about any specific valuation approach. But I would like for us to turn our attention back to intrinsic value. And our focus here is on enterprise value. Enterprise value is the value of the whole company. It's the value of the debt and the equity. And sometimes you'll hear enterprise value referred to as the market value of invested capital. Now, it's important to note that this is not the stock price of a company. This is the value of the whole company. And if we were to frame it in more mathematical terms, what we would say is that it is the anticipated future, because again, this is very forward-looking. It's the anticipated future net cash flow available to capital providers, discounted to present value using a discount rate that accounts for both the time value of money and investment risk factors. Many of you listening today are already familiar with discounting, but for those of you who are not, you actually are if you think about it in a more intuitive way. So for an example, a 50% probability of receiving $100,000 at the end of the year is worth a lot less to you today than a 100% probability of receiving $100,000 tomorrow. And that's because the first scenario is riskier and it should be discounted. And that's the exact same concept here, that cash flows, anticipated cash flows that are riskier or that are to be received farther in the future are just worth a lot less to you today than cash flows that are less riskier and should be received in the near term. So there's a mathematical formula for this. And that formula is that enterprise value equals net cash flow divided by discount rate. Net cash flow divided by discount rate. But we can expand this simple formula into a longer formula. And by doing so, it allows us to gain some insights into what drives value creation. And so if we look at the expanded equation, and I'm not going to go through the equation itself in detail, but I do want to call your attention to the themes and the factors listed below. There are 4 of them. So revenue growth potential is a key driver. So here we look at sales volume times unit selling price. If you increase sales volume, all else being equal, then the value of the company increases. And so you can see, similarly, if you increase unit selling price, but so the same number of units and nothing else changes, the value of the company would increase. Then this next set of factors, again, we're not going to spend a lot of time on the actual factors themselves. This is profit potential. So the higher the profit potential, the more the company is worth. And then we get into this set of components here that deals with asset utilization and efficiency. And we'll talk more about that later. Those first 3 components are the anticipated net cash flow part of the equation. And then that's divided by the discount rate, which reflects risk. So the higher the risk, the lower the value of the company, the lower the risk, the higher the value of the company. So all of these, taken together, represent 4 underlying factors that drive intrinsic value. And just as a reminder, these also underlie every commonly used valuation approach. So the first is revenue growth potential. And on the surface, this is self-explanatory. This is just projected revenue growth. Then profit potential, this is about the prospect of future profitability. Asset utilization efficiency just deals with using assets efficiently, stretching every dollar on the balance sheet towards generating revenues. And then risk is about the probability of meeting expectations, or alternatively, the chance that actual results will deviate from expectations. It's about the level of certainty that the forecasted net cash flows will actually be achieved. Now, my consistent experience over many years has been that companies who manage all four drivers effectively have a much better likelihood of success. And, I've seen this done the right way, and I've seen this done the wrong way. So two situations come to mind, and this is truly a tale of two cities. So the first scenario, we were called by a West Coast company several years ago, and this West Coast company had achieved significant revenue growth. They were achieving over $200 million a year in annual revenues when we met them. The founder was getting great press coverage and was great at building revenue generating partnerships. They were really great at the revenue growth potential of driver of value. But the critical flaws were, one, they were incorrectly pricing their contracts, and two, they were failing to negotiate favorable payment terms from their largest customers. And so they were literally losing money with every dollar of sales. So, they were neither managing profit potential nor asset utilization effectively. At that point, the only thing that we could do after going out and visiting, talking with them, learning as much as we could, was the only thing we could do at that point was just simply connect them with someone who could help them salvage their company. And ultimately, they ended in receivership. They had to wind the company down, and it was just a tragic business outcome. Now, in contrast, we met a small East Coast company in 2006. And at the time, their annual revenues were less than $2 million per year. And so we met with the founder and his management team, if you want to call them a management team, and we helped them develop a strategic plan. And that strategic plan was focused in on these four drivers of strategic value. So we helped them with four things. One, we helped them structure their business model so that they could capitalize on revenue growth opportunities. That's the revenue growth potential. We scrutinized their expenses so that their growth would remain profitable. That's the profit potential piece. We helped them renegotiate payment terms with their key clients, which actually freed up a lot of cash flow. That was an asset utilization factor. And very importantly, we focused the company on de-risking. And we did this by identifying and negotiating a multi-million-dollar investment from a publicly traded company, a large publicly traded company, who could provide not just capital, but also knowledge transfer that would help the company reach its next level. So for instance, they insisted that we establish a board of directors on which I sat, which is just a vital way to enhance the risk profile of a company. Now, within 3 years, we were able to buy back all the shares that we sold to the publicly traded partner. The company went on to achieve annual revenues in excess of $300 million a year. We then bifurcated the company and we sold the different divisions to global companies who were willing to pay top dollar. So it was a very good outcome. And the key takeaway is that we were very intentional on focusing on the four key drivers of value, which resulted in a very successful exit. So now we're just going to take a deeper dive into the four drivers of value. So the first is revenue growth potential. Now, revenue sustainability and growth potential underlies the valuation of every company. I mean, at some point, even if it's a few years down the road, there has to be demand for a company's products or services. And this can only be reflected in revenue. So we're going to spend a little bit more time talking about this driver than we will some of the other ones. But it's important to think about your company's revenue growth potential in a broad context. So it's important to start by defining the market opportunity, because the market opportunity enables you to assess the revenue growth potential and the optimal strategic positioning of your company relative to its competitors. And this analysis is divided into two interrelated, interconnected sections: competitive supply and customer demand. And I'm sure everyone on the call is familiar with the concept of supply and demand, and it's very relevant to the whole framing of your company's revenue growth potential. So first, we take a top-down approach. We define the basic need. So the target customer's basic need is the primary driver of market demand. And this is what Laura Newman, whom many of you on this call know, she's an entrepreneur in residence at UN Ventures. She would call this the global problem that needs to be solved. And it should frame both how you build and manage your company, as well as how you frame your entire pitch to a prospective investor, acquirer, or capital provider. The basic need defines the size of the market opportunity, but it also defines the growth trajectory of the market opportunity and of customer demand. So we see on this graphic an arrow coming from basic demand to the supply side, competitive supply. So competitive supply represents all companies providing products and services that meet the customer's basic need. To quote another entrepreneur in residence at the University of Maryland, Harry Geller, the purpose of these companies is to make things that people want and need. So competitive supply is just your entire supply of competitors who are developing products and services that meet the basic need. These products and services then lead to customer demand for those products and services. So if you think about it, if you have a basic need and now there's a product or service that can help you address that need, there's a good chance that you might actually want to buy that product or service. Now, as you already know, entire ecosystems composed of competitors and supporting supply chains emerge. And within those ecosystems, you have companies, particularly emerging technology companies, that are continuously introducing technological innovations into the marketplace. And as those technological innovations are supplied into the market, technology adoption becomes a critical factor on the demand side of the ledger. So every new product category or technology has an adoption curve, which is the cumulative rate that a population adopts a product, service, or technology over time. Now, an important point that I want to mention here, you see this graphic on the left-hand side. If basic need is at the macro level, meaning that it's driven by demographic changes, economic changes, cultural trends, et cetera, and competitive supply and customer demand are at the sector and industry level, technological innovations and technology adoption are at the industry verticals level. Now, industry verticals are specialized subsets of companies within an industry, be quantum computing, food tech, clean tech, et cetera. And you'll hear me use this word a lot during the remainder of our presentation, because for emerging technology companies, it's much more useful to talk in terms of industry verticals than it is to talk in terms of broad industries. So I just wanted to point that out as we continue through the presentation. Now, as we go down to the company level on the supply side, we deal with the concept of competitive advantages. Hopefully your company's value proposition, which is very important to define, will result in a competitive advantage. And if your competitive advantage bears out, it should result in increased market share, which you see at the bottom right of the screen. So what that means is it should result in customers buying more of your product versus those of your competitors. So as you can see, there's just a top-down approach that we take to defining the market opportunity. So let's consider an example. So here we see that the basic need is efficient intermediate distance travel. We have customers who have a need to travel intermediate distances, and they need an efficient way to do so. Now, intermediate distance here just means it's too far to walk, but you don't require a different mode of transportation like a ship or an airplane in order to cover the distance. And so we have, throughout the years, companies who produce vehicles for private use that are capable of efficiently transporting people intermediate distances So we've had those companies spring up, they've entered into the market, and thus they create demand for vehicles for private use. And we can see that the demand curve for those vehicles has increased over time. If we go back 150 years and we peer out into the future, we can see that the demand curve has increased and is likely to continue to increase out into the future. And this is because population has grown, cultural trends, et cetera. Now, as demand has increased, we've seen technological innovations come into the market along with adoption of those technologies. And so here we see that at one point, people fulfilled this need with horse and carriages and wagons in the past. Then as the internal combustion engine automobile was introduced into the marketplace, people began to adopt that as a means of transportation. And as we look out into the future, we can see that electric vehicles are becoming more and more popular and more adopted in terms of meeting this basic need for efficient intermediate distance travel. Now, here's what you will note. The basic need itself, driving demand, actually never changed. The basic need always remained the same, but three things did change. First, the number of customers having the basic need increased, resulting in higher demand. So the level of demand for the vehicles for private use increased, and the way the need was met also increased, or also changed rather. So, my guess is that more of you on this call know people who drive Teslas than people who drive horses and buggies and carriages. I mean, that's just my assumption. But this has dramatic implications for companies operating within the ecosystems that support each of these product types. So the revenue growth potential, for example, for a supplier of batteries and fuel cells is much greater than that of a wagon repair shop, if anything like that even exists anymore. So it's always important to zero in on and articulate the target customer's basic need and why that need is expected to grow. It's important to answer why your innovation will be adopted as a means for meeting that basic need. And then it's imperative that you explain how your company can effectively capture market share. Now, here's an example of a company. This is actually Amidas. Some of you may be familiar with them. They are actually a UN Ventures company. They're just publicly traded now. They are a renewable fuel and biochemicals company whose enterprise value, that is the value of the whole company, surged nearly 5x on growth projections. I mean, we saw the company literally over a period of maybe a 2-month period, their enterprise value surged over 5x. Now, what explains that is that today the company, or last year, the company did 164 million a year in revenue, but the projection is that this company can do over $1 billion a year in revenue by 2025. That's a 35% annual growth rate. So if we compare this to some of their competitors within that industry, we picked a small, medium, and large competitor, revenues ranging from 84 million to 18 billion. We can see that their growth rates are significantly lower. So Amidas at 35%, the competitors, small, medium, large, they're somewhere between 6 and 11%. So when we look at the valuation, so we're saying enterprise value, produced by every dollar of assets. So we can compare on what we call a pound for pound basis. We see Amidas at 742, and we see the smaller growth or lower growth competitors at much lower numbers. And the key conclusion here is that each dollar invested in Amidas is worth 3 to 5 times more than a dollar invested in the lower growth competitors that are listed. So a dollar invested in the assets of those lower growth competitors. Key takeaway here is pound for pound, companies with high growth, revenue growth potential are worth more than lower growth competitors, both smaller and larger. So that's the key takeaway there. Now let's move to profit potential. So an important thing to point out, because this has implications for how you think about your company when you're talking to investors or potential acquirers, is that generally investors are willing to make a trade-off between longer-term anticipated growth and near-term profitability. Investors understand that it may take years for a company to begin achieving profitability. And they will forego near-term profitability in exchange for high anticipated growth. So as we look at this slide, high anticipated growth verticals, the emphasis is on path to profitability for moderate to highly capital intensive businesses. And that's a very critical distinction. Why does path to profitability matter when you have high growth companies that are also capital intensive in nature? So a capital intensive company is one that requires a significant investment in fixed assets like machinery and equipment. They could also require a heavy investment in IP or software and technology. And so those types of assets actually depreciate in value over their useful lives. As a result, they have to either be maintained or replaced on a fairly consistent basis. And that cost to maintain or replace those assets is what's referred to as capital expenditure, Capex. And if we go back to the equation, you can see it show up here. And what this means is that the higher the Capex required, all else equal, the lower the value of the company. And the only way to offset that is either higher current profits, or if it's a high growth company, the anticipated growth of profitability. So the key here is, if you are in an emerging space that requires a high investment in fixed assets, be prepared to have the path to profitability conversation with your investors. For those of you who followed Amazon, if you recall, Amazon has been around for 20 plus years. They've been publicly traded for 15 of those years. But they did not become profitable until maybe 3 or 4 years ago. And those of you who follow the company and the investor community, there was a lot of conversation leading up to that time about path to profitability. That was a huge point of discussion on investor calls when it came to Amazon, which is a highly capital intensive business. Then at the other end of the spectrum, we have low anticipated growth or mature verticals. In these types of mature verticals, the emphasis is on current profitability. And that's because current profitability, current profit margins are a good proxy for future performance. Now, if you have an emerging company that is in a mature vertical, in other words, you might have a disruptive business model that comes in and disrupts a mature vertical, early market validation is key when talking to investors, being able to demonstrate early market validation. In other words, that people are willing to actually pay for your product and buy it, and that ultimately you can produce it on scale and you can produce it at a profit. So early market validation becomes key. And one example might be the alcoholic beverage industry. That's actually a very mature industry, but I'll give you an example from my own experience. So several years ago, I, along with several other investors, acquired a 70-acre winery and vineyard in Napa Valley. We acquired the vineyard from Sutter Homes. We leased the vines back to Sutter, but we converted the winery into what's called a custom crush and bulk storage operation. And basically what that is that allows vintners from outside of the valley to bring their juice or their grapes to us. We would process it, bottle it, store it. And then what they could put on their label was that they were a Napa Valley appellation. They're a Napa Valley wine. So we had about 30 tons of crush capacity for 30,000 tons of grapes, 4.6 million cases of bottling capacity. We had 8 million gallons of wine storage. And so it was definitely an operation of some scale. And we ramped up to nearly full capacity with our small and large scale ventnor clients. And then we sold the operation to Gallo at a very impressive multiple. Now, we made this investment early on in the growth of the wine production services vertical. So we had to demonstrate that the market would accommodate this business model in a meaningful way. And we feel that we did that to great success. Now, just to look at some industry verticals in which anticipated profit growth is rewarded. And there are more of them, but what we did was we looked at the portfolio of Ventures discovery portfolio companies. And these are some of the verticals that jumped out, but there are certainly more verticals out there where this is true. So in gaming is a vertical where there's a huge investment in intellectual property. There's a huge investment in software and technology. And in some instances, the outcome is a bit uncertain. Other agriculture, this includes cannabis, healthcare diagnostic equipment, which includes wearables and quantified self, advanced manufacturing. So if your company is in a vertical like these that require an investment in fixed assets, again, emphasize path to profitability when you're speaking to prospective investors and capital providers. And industry verticals in which current profitability is rewarded. Again, we're just really looking at where the Ventures discovery portfolio is concentrated. You'll have consulting, that's B2B consulting, business to business consulting, household appliances, personal products, any type of consumer non-durable product would tend to fall here. Those are more mature industries. The industries themselves are, have slower anticipated growth. For those, we want to emphasize market validation. Then we move to asset utilization and efficiency. So this is about using assets efficiently to maximize every dollar on the balance sheet to generate revenue. And this can be achieved by managing accounts receivable collections, customer payment terms, inventory management, et cetera. For those of you involved in businesses that maintain inventory or have lengthy customer collection cycles, what it means to have cash tied up in product or an outstanding customer invoices is something that you know very well. You know that those are assets that can tie up a lot of cash. Now, traditionally, asset utilization is measured using what they call the sales turnover formula. In this case, it's sales divided by assets. But it's also applicable to pre-revenue and early stage companies. And it shows up in the form of having the ability to manage the cash burn rate efficiently. And if you're at the beginning of just beginning to generate sales, it's having the ability to manage your cash conversion cycle. That is, employing strategies like collecting subscription fees in advance, et cetera. This is a significant driver of valuations for companies in verticals characterized by high investment in current assets related to customer billings or inventory, et cetera. And again, if we look at industry verticals in which superior asset efficiency is rewarded, we can see that SaaS is at the top of the list. That's software as a service for those of you who don't already know that. But in the SaaS model, actually customer billings is a critical generator of cash flows because typically the customers are billed in advance. Clean tech, we see nanotechnology, and which is kind of strange to see show up here, but there's a huge investment there in just inventory in all of its forms, raw, work in process, finished product. Health tech, beauty products, where there's a need to stock inventory. So these are areas where superior asset efficiency is rewarded. Now, last but not least, there's the driver of risk. And we see it in the equation here that risk shows up at the end of the equation when we're taking net cash flow and we're dividing it by the discount rate. So, investors are trying to understand a company's anticipated performance. So risk is the uncertainty that the anticipated future net cash flows will be received. And like revenue, sustainability, and growth potential, risk underlies the valuation of every company. There's no way to escape it. It is just a critical thing that has to be considered for every single company, whether you're emerging technology or not. And here we really focus on company-specific risk because that can be directly influenced by management. And company-specific risk is always evaluated relative to that of your competitors. So the essential question, as I call it, would be, how risky is your company relative to its competitors? And there are 7 risk drivers for early stage emerging companies. And these are listed in order of importance as measured by one of the alternative valuation approaches called the scorecard valuation method, with at the top being strength of the management team, then size of the market opportunity, then the product or technology, then the competitive environment, then marketing, sales channels, partnerships, need for additional investment, meaning is there enough capital to successfully execute the plan? Because one of the things when you start going to third-party investors, they're always going to be concerned about is potential dilution. That is, that more investors come in and dilute their ownership stake. And then the category other, which is just kind of a catch-all. And as discussed before, risk is ultimately quantified in the discount rate or the multiple, which is just the inverse of the discount rate. So minimizing risk drivers decreases the discount rate, which leads to higher values. Another way of saying that is that minimizing risk drivers increases the multiple, which also results in higher values. But let's look at another example. So this is actually from a recent headline. Some of you may be familiar with IonQ. So IonQ, it's a quantum computing startup. IonQ reached a definitive agreement to acquire DMY Technology Group through a reverse merger. That's a SPAC. Many of you may have heard that term today, resulting in the combined entity trading on the New York Stock Exchange worth $2 billion. Now, IonQ is about 5 or 6 years old. They were founded in 2015, developer of the atomic quantum computer technology. Again, this is a UM Ventures spinoff company. According to public records, the company did $0 in revenue in 2020. But they had an estimated loss of $42 million in 2021. So this year, they're projected to lose $42 million, according to public records. Now, by 2025, they're expected to ramp revenue up to a little over 200 million and have positive profitability of 61 million. So there's a nice growth trajectory there. But the question is, why is this company worth $2 billion? So what we can do is we can go through kind of the risk drivers checklist. We talked about the 7 drivers earlier, the 7 risk drivers for early stage emerging companies. So if we were to run through that checklist, we start with the strength of the management team. And here we can see sterling reputation of the founders, strong board with independent directors, world-class management team led by a well-regarded CEO. Even Forbes magazine talks about how great this leadership team is. They say that IonQ has strong business and technical leadership, and they go on to say some more wonderful things about the management team. So strength of the management team, we can certainly give them a strong plus, a strong check mark. Then we look at the size of the opportunity. So the total addressable market here is $65 billion by 2030, and that's a growth rate of about 56% per year. So here we can give them a check for size of the market opportunity. Then we go to the product itself, the product or the technology. So they're well into phase 1 of their roadmap with a unique way to tackle the quantum computing challenge relative to their competitors. And so we'll give them a check here. We go to competitive environment, we see a number of competitors, but there's really no clear market leader, and there are significant barriers to entry. So we'll give them a plus or minus because the jury is still out on competitive environment. For marketing, sales channels, and partnerships, they have some partnerships with Amazon and Microsoft Azure's cloud computing services. They have some other things going on. We're going to give them a soft plus there, not a hard plus, not a hard check. And then need for additional investment capital. Over the last 5 years, this company has raised over $400 million, $435 million to be more exact. And they've raised them from the likes of Airbus, Amazon, Bill Gates, Google, Hewlett Packard, Lockheed Martin, Samsung, Mark Benioff, Fidelity. So they have a world-class investor base. This is where the smart money is investing. And we also see that after this offering, they'll have adequate funding to fund them through the final phase of their technical roadmap. So we would certainly give them a check mark there. Now, whether or not the company is actually worth $2 billion, I mean, who really knows? But we can see that relative to other startups, a high valuation is certainly warranted, both because of the significant revenue growth and profit potential, but also because IonQ's risk profile is measured by these 7 risk drivers, gives investors confidence, or what we would say conviction, that expectations might be achieved. So now, just to kind of wrap all this up and tie everything together, we can boil it down to the following. It's important to manage and build the value of your company by pursuing strategies that create cash flow and present the highest likelihood of success. I mean, that really is what that entire valuation equation, intrinsic valuation equation, is about. And in addition to doing that, it's important to effectively communicate those 4 intrinsic value drivers in a way that is relevant to your industry vertical and your company specifically when pitching and negotiating with prospective investors, capital providers, or potential acquirers. And I'm happy to take any questions that you might have.
Nigel, that was incredible. That was basically my MBA course that I took for an entire semester in 45 minutes. So thank you. So we do have, so the first question is, will the slides be available to us?
Absolutely.
Okay, so we'll share the slides.
And not only that, the slides will be available, and if anyone wants to have a follow-up conversation about it, I'm available for that as well.
Yeah, thank you so much. That's very generous of you. So do we have any questions from the audience? So you can either type them up in the Q&A, you can also type them up anonymously if you wish so, or you can raise your hand and I can unmute your mic and you can ask it live. We're waiting. And so while we're waiting for questions, so the question I have, Nigel, so usually when we were talking to VCs, they just discount whatever valuation that the company presents to them just by 50% automatically. Is that true? And
yeah, for some VCs, that is absolutely true. I will say that in this market where there's just so much liquidity sloshing around the globe, and where you are seeing record valuations for companies at all levels, including early stage, including angel and seed, that is going to become less and less the norm. What we're seeing now when we talk to investors at that end of the market is we're seeing, certainly at the smaller end of the market, we're seeing more formulaic methods of coming up with valuations. And once we get into the VC round, they are certainly sharpening their pencil so that they can actually, make a winning bid if they're going to spend time looking at the opportunity, because they know that other people are willing to do those deals now because there's just so much capital out there.
Yeah. Do you think we are in a bubble?
You know, I'm hesitant to call it a bubble, but I will say that we're seeing record inflows into angel, seed, really all phases of investment. We're seeing record inflows. At some point, that's probably going to subside. We just don't know when. I would say that if we should not assume that the record pace that we're seeing now is going to necessarily be the norm consistently over the next 10 years. We just don't know.
Yeah. The rise of more democratized mechanisms for people to invest in companies, their Start Engine and others, I think it just became more available to the general public. I think maybe that's part of it.
Yeah, absolutely.
Yeah. Well, if I don't see any questions, but this has been absolutely fantastic, Nigel, and I can see, so we will post this on YouTube, and I can see myself definitely recommending this to most of our startups. Go and watch this presentation, because you explained this very difficult topic very succinctly, and I hope that's why we don't have any questions. So thank you so much.
Absolutely. Thank you. It was a pleasure. Thank you, everyone.
All right. Thank you.